So this week, we're going to talk about affordable lending options for your clients. Knowing those options are really important because there's a lot of people who think that they can't qualify, and they actually do. It's just going to be a little bit more of a challenge. And it might even take a lot more negotiations on your part because you're going to be asking for seller concessions to make this work. And then we're going to roll into manufactured housing, because that's a good an option. However, I'm starting to see manufactured housing is going up considerably. But that's a lot of times because it's sitting on land, and land values have gone up so much. So, but we're going to talk about manufactured housing. What is really important that I hope that you guys all get from both classes today is, number one, that there's options. There are, golly, Brandy, I don't know, you and I, if we were to guess how many different loan programs that Guild offers, what is it? 400 or 500 different programs between, by the time you do variations, it's a lot. And then every lender's got, like, we've got some specialty programs that are just a Guild program. One thing that we are very blessed with having the opportunity to beta and pilot programs for Fannie and Freddie, because we're one of the largest mortgage companies in the country. And we also have such a solid record. I mean, we've been around since the 60s. We service our own loans, which gives us some flexibility. And we also have just a really successful track record with our leadership team, highly recognized and respected in the industry. So both agencies will roll out programs that aren't available anywhere else, just to see how well those loans perform, especially if it's more of a high risk loan. And a high risk loan to a lender would be a loan with lower credit scores and higher debt to income and less down payment, which is what you guys, a lot of your clients need more of. So we'll go over some of those programs as well, so you guys can see that there's options, and then know that other lenders have special programs as well. And then understanding mortgage basics next week. Let me back up. So on the manufactured housing portion of today's classes, I want you guys to know, when you do pull up to a house, or someone call to show a house, or you're pulling the MLS and you see it's a manufactured home, what questions should you be asking? How do you know it even qualifies for a mortgage loan? Huh? Yes. And then whenever you get out to the property, what are some of the things that you need to be looking for? If you're listing the property, what are some of the things that you need the seller to go pull for you, so you can put in the MLS to make sure that there's not any problems with the transaction once you get a contract? All of these things are really important. And there's a difference between the requirements on a single wide and double wide. And what are they? So we'll go through all of that in the manufactured housing, so that you guys aren't uncomfortable showing or listing a manufactured home. Or when you see one listed, you'll know what's missing before you even go show the house, so that you can make sure that when you go show this house, the buyer really can buy it, because their only funds available are mortgage loan funds. And so if it doesn't qualify, why show them for the house? I mean, you're going to get them all excited unless they've got some cash they hadn't told you about. But then next week, we'll talk about understanding the mortgage basics and closing costs and prepaids. I want you guys to have a pretty good understanding of what goes in both of those categories, and how to even figure that stuff. Like if you're out to dinner somewhere and someone says, hey, we're thinking about buying a house, you should be able to give them some roundabout information. You're not committing to all of this information, but you should know enough to have a conversation, and then to have something to follow up on whenever you get back to the office. And then the last is some marketing and branding. So you are your brand, and really understanding that you are your brand. You don't have to have a fancy catchphrase, or you don't have to have a fancy hashtag or any of that. When people search you, it's you that they find, not all this cutesy stuff. So don't overthink your marketing and branding. And then attracting and engaging the next gen buyers. Easy conversation for you, Carmen, because you are that buyer. So, but we're not. So what are some of the things that we need to be looking at and thinking differently about? So we'll go over that as well. And I'll appreciate your input whenever we get to that. All right. Let me go back to see if there's any questions. Oh, thanks, Brandy. We don't have anybody else new on and don't have any questions. So what are you guys finding whenever you are, Kami, have you shown many houses? Have you talked to many people yet?
No, not a lot.
Not? Okay. What if, well, but your husband's in the remodel business. So why are some people choosing to remodel versus moving, buying? Hey, Jen.
Because it's cheaper.
Affordability. So Kami's husband remodels homes. He does a great job on social media. Do you do that for him?
No.
He does a good job. Yeah. Number one, he does a great job of just showing the projects that he's doing, which is always interesting. And I mean, tell him, I mean, I comment on his stuff, so I know he notices, but he does a really good job. But like Kami said, I mean, people that he's remodeling homes for, they're choosing to remodel and stay where they're at because of affordability. And we're seeing more of that. Is he busier now than he had been in the past, or has he always been super busy? Mm-hmm. Do what? What did you say, Beverly?
I need a card for a good remodel.
I know. That's probably why he's, I mean, that is why he's busy, because he's good at what he does. He probably does what he said he's going to do. Or Kami will have him. Yeah. Or show up. Yeah, show up. But affordability it's a real concern in this area. And I think part of the housing shortage, I know part of the housing shortage that we're all dealing with is people don't want to leave the affordable home they have. It's either affordable because they bought it several years ago, or it's affordable because of the interest rate they were able to lock in, or they just recently refinanced when the low rates were lower. So it's hard to turn loose of that for something that's going to cost them more money, even though they really want to make that move. So understanding what programs are available for them is really important. Hi, Danny. You look like you're in a cave. You are? Good. Caves are fun some days. I'd like to hide in one, but it wouldn't have a camera or internet. So one of the things that have you guys heard all of the controversy over the new LLPAs, loan level pricing adjustments? Ben, you have. Danny, you haven't? Okay. I wanted to briefly talk about that just in case you guys do run across that conversation. So that you can, while we're talking about affordability, let me just even show you what it looks like if someone came to us asking for, and I'm going to share screen in just a minute. I know what you're fixing to say, Danny. But let me get in here first. So let's just do a scenario of, actually, let's look this up. Average credit score in Texas. Ooh, 680. I was going to do the 680 scenario. All right. So that's number one, you guys should know. 680 is the average credit score in Texas. Texas typically has lower credit scores than other parts of the country. Yeah. So somebody that's moving here from out of state, or someone from Texas moving to other places, just keep in mind there's income differences typically, and then the credit score differences. And both of them matter whenever it comes to what they're going to pay for an interest rate. Okay. And that's what I was trying to pull up for you guys. Let me share a screen for you guys on Zoom. All right. So let's just do this scenario, 680 credit score. We're going to say they have a 44% debt to income, which 45 is really about the highest you can get without having any issues. And a lot of times it can't be more than 44.4%, because if you tip over to that 45% debt to income ratio, we start having problems getting the loan approved. And this is going to be Grayson County. You see all of these blanks that I'm filling in have something to do with the interest rate somebody's going to pay. We're going to do a conventional loan. We're going to do a fixed rate. We're going to do a 30, and they are going to escrow, which again affects the interest rate, whether or not their payments include taxes and insurance. What's the average sales price in Grayson County? Do y'all know? Sales price in Grayson County? $314. All right, and let's say they're going to put 5% down. And this is a purchase, again, that matters too. And gotta move this stuff around so I can get, all right. So let's see what pricing options are available for these folks. Do what? I do too. Yeah. See, so in this scenario, this is all of the different loan programs that would be available for that person with that scenario. And you see each one of these options have different interest rates. But let's just say in this case, we are going to just price this as an in-house loan. We prefer to service the loan if at all possible, because if there's problems with, you know, an insurance claim, or they have issues with escrows, or they are just struggling to make their payment and they need a loan modification, I know I have the ability to help them if I'm servicing the loan. If I sell the servicing to somebody else, then I might not be able, I won't be able to help them in any way. I'll just tell them, call the customer service number that's on that payment statement. So we always prefer to service the loan ourselves. Now, there's times in our industry where people are paying more to buy the servicing rights of a loan than what the profit is for us to service it ourselves. So there will be a disparity in the pricing of us keeping the loan versus us selling the loan. The difference for your customer, if I'm selling the loan, is not any different than them going to work with the credit union who's going to sell their loan to. So if I have somebody that you know is shopping me with a credit loan, a credit union, then I want to be able to show them, okay, I can offer the similar type of pricing, but it won't be the kind of service that most of our customers are willing and wish for later. But sometimes cheap is all they care about. And so I can price that loan just like the credit union can price the loan. But the service goes away, just like the service goes away when the credit union's doing the loan. And we're starting to see that a little bit in the industry right now. A lot of your banks are filing, even Wells Fargo quit the mortgage business. So Wells Fargo's not even, they're not servicing loans. They sold all their servicing rights. So we're just in a real funky time right now in the mortgage industry as to who wants to be in the industry and who does not want to be in the industry anymore, because it's not a money-making industry at this moment. And so that's why you'll see all of these different options. Now, every one of these options come with different loan guidelines. So what a customer looks like they might qualify for this loan based on the 680 credit score, 5% down in Grayson County on a regular stick built escrowed loan with, with this wholesome, with a 44% debt to income. Every one of these loans within this has guidelines that still may or may not fit in. And we either have that information memorized or we spend hours digging through guidelines. So But in this case, let's just say that we are going to look at, we're just going to look at a regular, I'm looking for the 683. A regular conventional loan. So we'll go right here. So see right here, if I do this as just a regular loan right here, that means that their payment's going to be 20. Well, let me go back. I don't know if I can go back. I can't go back. See if I click on this, if that goes away. No. See the payment right here, if I'm just looking at this and not digging any deeper, that's got a payment of 2111, right? Whereas if I could squeeze them into a different loan program up here, the payment would be 1959. So what's the difference, right? I got to pull the guidelines and see. And would they qualify for that lower interest rate and the lower cost? So when we're talking about home affordable, we're looking at all of these different loan programs because there's a difference in 1959 payment, almost 1960 and 2111, right? And so that's what I want to go over with you guys today, but I also want you to understand too, like I was reading an article and what the consumer feels would make them really excited about buying houses again is a 5.5% interest rate. Well, in this scenario, someone could get a 5.5% interest rate, but it would cost them 5 5/8 points. So you basically take a sales price of, a loan amount of $314,000 minus 5% down, and your points are going to be basically equivalent to what they'd be paying in down payment. But if that's what it takes for them to get excited about buying a house, do we need to see if there's any way we can negotiate to see if the seller would pick up some of the closing cost, to help them buy it down? They pay a little bit to buy it down, or do we need to look at a temporary buy down to help them get to this rate? Because remember, if we did a temporary buy down and the rate started at when it's 7 7/8, yeah. So if we did a temporary buy down at 7.625, if we did a 2-1 buy down on that first year, the rate would be 5.526, right? And then the second year would be at 6.625. And the third year up to 7.625. And for the rest of the term, it would be at that 7.625. Because you're on a 2-1 buy down, a temporary buy down, they're only buying it down temporarily. 2 points the first year, 1 point the second year, and then the rate goes. So there's so many different ways to approach this sort of whole affordability conversation. And my point for you guys is you don't have to be an expert at all of this. You just need to know what's available. You need to be able to articulate to the customer, listen, I don't know if what you're asking for is possible, but let me know, what does it take for you to feel comfortable to buy this home? It's exactly what you guys said you wanted. What is keeping you from making a buying decision? And listen and get all of that information and then give it to us so we know what objections we need to try to overcome to help you get them under contract. But then you got to know this information too, because you got to fight to get the contract to help them make this happen. Because this may not be a lay down, easy peasy, fill in the blank contract. This might be a contract that's full of negotiations. And then if you've got someone that's barely affording the home and you're writing a contract for them, you also want to be mindful of that when the inspections come out and the seller saying, I'm not fixing this stuff. And you've got to know that what the buyer is asking the seller to fix might take them a couple of weekends to get it done, but it is something they could take care of. So don't give up on the house. Because that's the other thing that we're seeing right now is people feel so stretched and they feel like they've paid every penny they can afford to pay. And then the sellers are refusing to do any repairs, and then the buyers are they're canceling. because they already feel they are on the edge. So now on all of those loan level pricings adjustments, the one thing that I wanted to show, we've all over the news has been how the pricing adjustments have changed. What I want you guys to notice in this scenario is this person, because they're only putting 5% down and they have a 680 credit score, they're paying an extra 1.375 for that rate. If they had better credit scores, then they would either get a better rate or they wouldn't be paying this 1 1/8 discount point. In fact, they'd get a little bit of a credit to go towards their closing. So I could go in here and I could change this scenario where they input in here that they have a 720 credit score, just so that you guys can see. And this is not the only factors that determines the credit score. But just to give you an idea, when people say they're shopping interest rates, they can't, it is not possible to shop interest rates unless you're calling with the exact same scenario on the exact same house, because the house matters, at the exact same moment. You can't shop. All I'm doing is estimating what I think that's going to be, because I have no idea when you're going to find a house. I have no idea where the house is going to be located. I don't have any idea what kind of home it's going to be. I don't know how long your credit report is good, and if I'm going to have to pull a new one whenever you do find a house. So all anybody is ever doing whenever they are shopping interest rates is getting people to give them a best guess or whatever they think that the buyer wants to hear in order for them to make a decision to do business with them, which to me is a bait and switch. You can't shop rates because every bit of this information changes every day and sometimes throughout the day. And it is very specific to the exact scenario. But in this particular case, let's just look at the difference between the credit scores. So if for that same scenario on the same house, the difference being a 680 credit score versus a 720 credit score, this interest rate for the same discount points would be 7.375. So it's a 1/4% difference in interest rate, only because the only thing I changed was the credit score. If I change the credit score to a 640, it's going to make the interest rate probably almost 8% for that same amount of discount points. So again, this is why people can't really go shop their interest rate, because all of this information is changing constantly. And it's also specific to the exact scenario at the exact time for the exact time that you have on the contract for the closing dates. But all of that factors into affordability. And that's what people are thinking. They think the best way for me to be able to afford this house is to get the cheapest interest rate. And that's wrong. I could show you an equal payment on a 7.625 680 credit score versus the 720 credit score at 7.375 just by changing up the mortgage insurance premium, the way in which they pay between the two. I could make those payments pretty close match just by changing the strategy in which they are paying for mortgage insurance with that 5% down. Oh, did I not share the screen when I showed that second scenario? Oh, well, I could share. You get the point. So does that help y'all as far as that conversation, understanding, when someone's talking about, well, this is the top of the market for us, we got to find the cheapest interest rate. No, you really need to find the best finance strategy, because we can a lot of times find better ways to save you more money with a different scenario. And one of those that I was going to share with you, a recent change that we just experienced is someone who is under the area median income of 100%, if they're at 100% of the area median income or less, they're going to get a better interest rate than what someone would if they were over those limits. So where this is going to really help is our younger first-time home buyers. So I got a chart for you so you can see what that income is. But first, what I wanted to show you is the average. Oh, let me share screen because I want them to see this too. Oop. Hey guys, got y'all lowered so far. I couldn't find you. So the average income in Grayson County, I'm gonna minimize this. What do y'all think the average income is, household income in Grayson County is? I'm gonna watch chat. Y'all put it in chat and let's see what your thoughts are. Does anybody have a guess on the average household income in Grayson County? Y'all are not very brave this morning. 80? Okay. Beverly guessed 80,000.
45.
45? Okay. Carmen, you guess 50? 60. Jen is the closest. The average income, oh, Danny said 60, 65. Those, the average household income in Grayson County is 62,000. 63,078. That's household. Okay. This is as of, and that's old stats. So we're probably, I mean, surely it's bumped up a little bit because that was through 2021. So Danny may be closer to right, maybe 65 to 70, but still. You know what? Actually, here's that. If I scroll on down. Hey, you know what? We bumped up quite a bit just in the last 2 years. This report is saying 88,000.
Well, that's what I was thinking because we've had so many people come in here from other states.
Yeah, the income has bumped up a lot. That one, look, the census is showing 62,000, but that was through 21. And if you're looking at the Grayson County demographics from, now I don't know who Point to Homes is, but they're showing 87,000. So that makes more sense with the increase in our prices. Let me show you what I know, and this is what's going to be, and I want you guys to do a little math here, but look at the area median income limits for this area. So a lot of your down payment assistance programs and your first time home buyer programs are going to be based on the Brady, what did I do wrong? Where'd my numbers go?
You have to put in an address on that one.
Oh, I don't want to do that. Okay.
Go back to the chat and you'll see the one that
That she
Nicole
pulled up.
Mhm.
Oh, because okay. I thought I saw one with the actual. All right. So a lot of your down payment assistance programs are all based, or they're income driven. Now, the difference is some of them are household income, some of them are qualifying income. And the difference between household income and qualifying income is if you have a husband and a wife on the loan, and I don't need both of them to qualify. And if I put both of them on there to qualify for the loan, then they would be over the income limits that were allowed on DPAs or grants. But I don't need them. I don't need both of them. So I would choose whichever one is the best out of the two, and I would take the other one off. So now I have qualifying, based on the qualifying income, they might work for one of the DPAs or grants. Now, other programs require you to use household income, and that would include anybody in the house that is bringing in income, including teenagers, or if you had an aging parent that was in the household. You
Hey,
technically are
Michelle,
supposed to include them too, yes.
if you only have one of them on the loan, but we write a contract and take it to title with both of them's names on it. And worst case scenario, 2 years down the road, they split up. Is just the one person liable for the loan?
That is correct. Yep, they both would be entitled, but only one of them liable. So then I gotta have to figure out who's really gonna keep the house, and whoever, if the opposite person that's on, then who is on the loan decides to keep the house, they'll have to refinance it in their name. Yeah.
Thank you.
But good question. So in this case, so just understand that there is a difference between household income and qualifying income. And then the other scenario that we see whenever you're talking about affordable housing and all of those programs is USDA will require that we take the past, the income received in the past and do an average, but then we also have to take the current income, compare it to the past income, and forecast what the income is going to be. And that's what would determine whether or not they qualify with the income restrictions. So, and so if you're using a USDA loan with a grant or a DPA, you have to consider all of that, because this one still might be household or qualifying, but USDA is still going to do their own income calculations, and you got to be able to qualify them for both. But just to go back to the affordable housing, so the area median income is $78,000, $78,200. So anybody with a household or qualifying income in that price range should qualify for some of the programs that are available that will help make housing more affordable. And they make it more affordable by less down payment, reduce costs to the interest rate. All of those costs that we were looking at just a little bit ago on the interest rate, that would go away in some programs where you're just paying a base rate. And then mortgage insurance premium is considerably different if they qualify for those programs, making home more affordable. Again, it's all income restricted. And in some cases, it's also restricted to being a first-time home buyer. So I'm going to go through a couple of slides just so that you guys can see some of the programs that are available. So you have an idea when you're talking to people and they say, you know what, I'd love to buy a house, but I don't think that I could really afford one. You can say, wait a minute, I think I heard about a program the other day where you could possibly afford this house. Anybody have any other questions while I'm pulling this up? And Danny, thumbs up or down? Do I still have the screen shared? Down, okay. It needs to be a, well, there is. Where is? Okay.
There we go.
All righty. So there's the programs that we try to make available for more of your home, to make home more affordable, smaller down payments, because coming up with money out of pocket is really difficult, especially if you're not selling a house. I could Google the average savings that most people have, and you'd be surprised how little money people have in their bank account. Their wealth is in real estate, and it's I'm gonna pull those stats and put them in y'all's summary. Is how much wealth is in people's real estate versus cash in the bank. It's incredible. So without the sale of a home, a lot of people don't have a lot of money to put down. So providing affordable financing is minimum down. And then the lower monthly payments, again, the lowest payment is not always the lowest interest rate. It does not always correlate. And then the down payment assistance and the grants programs that are available. And we're going to cover a list of these programs. Here's just a few that we have. But what and some of these aren't available yet in Texas, but they're coming. Every one of these has a flyer that goes with it. So if any of you guys want to co-brand on a flyer, you get a hold of Brandy, you get a hold of myself, and you just tell us, listen, I want to co-brand and post this on my social media, but I need you to tell me more about it so I can do a video about it as well. You guys could do a green screen and have that flyer right behind you with the highlights and the big, bright, pretty colors. So you don't have to worry about the background that you're on. And you could just be talking on camera about, hey, listen, I hear you. I know it's hard to buy a home right now, but I've got some special programs that I just learned about that would help you buy a home with less money down, lower monthly payment, and maybe even some down payment assistance or grant programs that we can use. And you could just have a flyer right behind you on green screen, on Facebook, on Instagram, on all of them. If you just go to Reels and you hit, you scroll down on the filters, you go to green screen, and then you just put the picture that you want behind you, and then you're in front of this picture in this pretty flyer. So any of these that you guys want to do that, or maybe you just want to do a screenshot and just post it and say something about it. Be talking about how affordable housing is and how there's great programs available for them. There's some other marketing ideas that I have for you in just a few minutes. So Fannie Mae HomeReady. Fannie Mae HomeReady does have income restrictions. So if you look down below under income eligibility, they have to be at 80% of the area median income. So where the area median, the 100% of the area median income was 78 or 76, 78, 78. They have to be at the 80%. There's actually a chart for that. In fact, if I were to flip back over, you would see what it breaks it down for you.
62,560.
62,560. So as long as their income is below that. Now, Brandy, on that one, is it household or qualifying? Do you remember?
No, but let me look it up.
So that one is it may be on here. The benefits to this is we've got flexible down payment program available. We can go up to a 97%, so only 3% down. So you do a 3% down, you get some seller concessions to help cover some of the closing costs, and we actually can put a DPA or grant with this to help them get into the house. They have cancelable mortgage insurance. Why does this matter to you guys? Mortgage insurance on a house in this price range is going to be, golly, could be as much as a couple $100 a month. Houses are appreciating right now. We're one of the few lenders where if you give me a call today and you say, I'm in the middle of this right now with the customer, he bought a house 3 years ago, values have gone up, and he's done improvements to the home. He put 5% down when he bought the house. The house is appreciated enough now that he has 20% equity. So he bought the home with 5% down. He is paying monthly mortgage insurance on this house. Now he has enough equity. I'm helping him get that insurance, that mortgage insurance removed, and he's not having to pay a dime to get it removed because we are servicing the loan and we are putting on these cancelable mortgage insurance. So as these houses are appreciating, we're able to go back a couple years later and get the mortgage insurance removed, making home even more affordable. And then we got some flexibility on the income whenever we're doing the income calculations. Now, please know and understand that a lot of these loan programs require that the customer go through some education, which is a good thing. There's some really good courses that they have to take, but they do literally have to take the course and get a certificate and send us a copy of the certificate before we can finalize the loan. Well, when somebody is busy with their kids' schedule, you know, baseball's in full swing right now, no pun intended. And, you know, soccer's going on. And so you got kids and you got end of the year school programs and all of that. And they're in the middle of trying to make a move. Doing a home buyer education course can be a little bit stressful. So they might be a little cranky, but they're also saving some money and you can remind them it's worth the money. This works really well on duplexes. It's too bad that we don't have more duplexes because how cool would that as your first home to be a duplex that you get in with 3% down, affordable payment, and someone's covering the payment for you because they're renting the other side. It's just a shame we don't have more of those.
Hey, Michelle.
Yeah.
I just got an email from a broker and in the Sherman Denison real estate average sales price in March was $345,000.
See how fast, we can't even internet can't keep up with us. Yeah, 345. I want to let's pop over here real quick. Let's see, what is the payment on a $345,000 house? Anytime you guys want to run some payment scenarios, you can just go over here to our website and just go into the mortgage calculators. I'm going to just go into the mortgage payment calculator.
And check this out, Dallas Fort Worth was 467, 492 average sale price.
Good gosh. Okay, let's just say the rate's as high as 7 3/4. Now, FHA rates, just FYI, are a lot better than conventional right now in most scenarios. But this program that we were just looking at is a conventional loan. So we're just going to assume that they've got decent credit. So the payment is $3,600. Can you believe that? What did we say their income was?
88.
Okay. So what is that a month? Okay, so $88,000 divided by 12. So $7,000, 7333. Yeah, and let's just say that they're only paying 25% in taxes. Whoop, did that wrong. So they're bringing home $5,500 and their payment's going to be $3,600. You guys understand why people are freaking out? Yeah. Okay. I mean, I just want you guys to understand the reality of it all, because some of us may be sitting in houses that we've had for a long time and the payments are affordable for us. And so we don't understand why people are freaking out. Why do they cancel it at inspection whenever there's something wrong with the house? Well, hell, they can't afford to go to Lowe's or Home Depot to fix it themselves. Or why some people are choosing not to sell their house and buy a new house. All right.
Did I understand that right? That their household income is $54.99 and their payment's $35.92,
Yeah.
which only leaves $1,800 for other household expenses.
Yeah.
Wow.
Okay, here's another program that helps. Now, this one, what's great about Borrower Smart is you can use this program with the income being 140% of area median income. So that makes that more a lot easier. Now, the problem with this right now, this is a program that helps. We're contributing $1,500 of lender credit on this particular program, which is helping to offset part of that 3% down. But it's only available in certain areas, and that's why you don't hear much about it in this area. So this would not help us specifically, but just know that Fannie and Freddie are very mindful of what we're dealing with, and they're trying to find ways to roll out programs that will work to help people to help make home more affordable. Now, this is another down payment assistance program that's not even available in Texas. I'm going to scroll right over this. The zero down FHA loan program is a program that's available. And the reason y'all don't hear us talk about it so much is because the second lien, the down payment, it's really not 100% financing. They're getting a second lien for the 3.5% down payment. And the interest rate on that makes the payment go up to a point where it doesn't make sense. Just know that you might hear people talking about this, but again, until you crunch the numbers, it's just sound bites. But it is a program that is available. And that's one thing we're very mindful of. We do business with people we know we're probably going to see at ball fields, grocery stores, fundraisers, or just walking the streets downtown on a festival day. And so we're very mindful of making sure that it makes sense for that family. but there are some programs that you guys might see more and more of. Now, another thing that we're seeing, because it's harder and harder. I mean, think about that college student, they just graduated, they've got a degree, they've got a bunch of student loans, they've got their first job, and it's not paying a whole lot. And they don't have any money saved up because they've been in school. And you don't have any money to give them to help them buy a house, because hell, you just help them through school. So a lot of parents are having to make that decision of how am I really going to help my kid get started in the real world? And so we're seeing more and more ADUs. We have older homes. Some of them have garage apartments still that maybe could be remodeled and turned into an ADU. And we could use a home renovation program. I would love to talk to your husband about maybe promoting more of the stay in your home and renovate what you have, or renovate this detached garage into living space that you could turn into rental, and what those numbers would look like. Or buy a home that has the ability for you to do a renovation loan with the purchase, so that you can get some rental income coming in on an accessory dwelling unit. So just don't be scared of that conversation, because there are options with as little as 3% down. And then FHA loans, you know, for a long time, people always thought that FHA loans were just for first-time home buyers. It's not just for first-time home buyers, but it works well for first-time home buyers. And a lot of it's because not just the 3.5% down payment, because Fannie and Freddie offer 3% down payment for first-time home buyers, but your second-time home buyer, maybe they want to sell their home, pay off a bunch of debt, and still only buy a house with minimum down payment. So FHA makes sense. FHA a lot of times has lower interest rates. They have more forgiveness on higher debt to income. They have more flexibility whenever it comes to seller concessions. We can go down to a 540 credit score on an FHA, which is a really big deal. Now, they can't do that with 3.5% down payment, but it's still an option where that wouldn't be an option on other loan programs. So there's a lot of reasons that you'll see FHA as a solution for affordable housing. Another one that's pretty new to us, not new to HUD. This is a HUD program. It's a Section 184 for Indian Home Loan Guarantee Program. And it is for your Native Americans on to be able to purchase property on non-tribal land. It's 2.5% down payment. So if you're licensed over in Oklahoma, this might really be something to be talking about. Danny, this is something you could turn this into a flyer and green screen it and talk about how home affordable using the 184 could be.
Years and years ago, I actually sold
to Choctaw. Choctaw does have a grant that is available for their people, and it works in Denison. I mean, it works in Texas, and we've done those loans for years too. We always have to go back to the vault to get the guidelines out, because you know it's not that often we see it, but we do that program too. I don't know if you could do the Choctaw with the 184, but it's possible that you could piggyback those together. Yeah. Complete Rate is a really good loan program for people that have absolutely no credit established at all. So if you've got a young home buyer and they never opened up a credit card, they have no credit score at all, it is possible that the Complete Rate would be a good option for them. While we're talking about the more challenged programs that are typically available, the I-10s. So if you don't have a social security number, it takes a long time to get citizenship, and it's very expensive. I mean, Veronica, who worked for us, worked on citizenship for 20 years. And I can't tell you how many times she would go up. I mean, it would be up for, no, it wasn't 20 years. Her parents worked for 20 years. Finally got it after 20 years, but she couldn't even start on hers until after they got citizenship. But she was in her mid-20s before she was able to do it, because she had to wait on her parents first. And so she would just have to spend thousands and thousands every couple of years to renew her work visa. She didn't have an option. So this program would be good for someone like her in her scenario. She's been in the US since she was 2 years old. She's worked and earned income since she was able to work. She's paid taxes but didn't have citizenship. So an I-10 program would be a great solution for her. They do have to put 20% down, but there's no mortgage wait. Yeah, it's a 20% down loan program. Before these programs existed, people were going to really basically loan sharks. And I can't tell you how many times people would come to our office after they'd given up a bunch of money and they go to close and this place didn't even exist anymore in the suite that they had been going to and given money to. So I'm really thrilled that we're able to service that community in a safe way because they hadn't always had safe options. So if you know anybody in your office that speaks Spanish, we have a Spanish speaking loan officer. He's in our San Diego office that I just refer those to, and we do have programs available to help serve them in a safe way. So this is a really, really popular program, and I wish you guys, I need to promote it more also. But you could go into Home Depot or in front of Home Depot and talk about this loan program. It's our 3-2-1. So basically they get into the house for 3% down. It is for first-time home buyers. We're okay down to a 620 credit score. And there are income restrictions. However, when they buy the house, they get a, Brandy, remind me, it's been too long. Oh, here it is. They get $1,000 they get the $2,000 gift card to Home Depot. They go to closing and we give them the information to cash in their $2,000 gift card to Home Depot. So 3% down, they get a $2,000 gift card, and we're going to give them between $1,000 and $2,500 towards their closing costs and down payment. And this is a program that is exclusive to Guild Mortgage. And we're not talking about it because I really almost forget about it because it's been, anyway. So this was when I was going through these slides last night, I was like, oh my gosh, I totally forgot we had this really cool program. There are income restrictions.
I was fixing to say, I will say the income's really low on that.
Yeah, isn't that one an 80% AMI?
I think it may even be lower than that. I can look.
Yeah, will you look and then chime in a few minutes and tell us what that actual income is? But it's still something to talk about so people can get out of their heads that home is not affordable. Yeah.
Is that household income?
Yeah, and Brandy, will you see, is that household or qualifying?
What was the amount?
She's looking it up.
Yep, let me look it up.
Payment Advantage program is another program that we're using where we can, now this requires participation with the seller. But on the Payment Advantage, if the seller is willing to buy down the rate 2-point buy down, we're going to give a 1-point buy down. So they're going to buy the rate down for 2 years. We're going to buy the rate down for 1 year. The buyer can get in with as little as 3% down. And so their start rate is going to be reduced for the first 2 years. And then once it's fully amortized, they might be paying, 7.875. But if we couple this with the Payment Advantage Plus program, then whenever the rates go down, we're just going to refinance them and they'll still be in that lower buy down bracket. So it's a way for them to get into the home and their rate be, or their payment be maybe, well, it would be based on, in that scenario, 5.875 for the first year, 6.875 the second year. And then within the next 2 years, we'll see a drop in the rates and they'll just refinance. And we're not going to charge the lender fees for them to refinance. So it's just something to be talking about so that people know there are ways to make it happen. Again, you guys have got to get really good at negotiating with the sellers because you're going to have to get a seller buy down on this one. And we'll tell you exactly what that amount is whenever we get to that point. Now, I'm going to skip the Freddie Mac Choice Home because we don't have those available also in this area, but the Manufactured Home Advantage is for cross mods. It is a really cool program. I'm not going to spend a whole lot of time on it because we don't have any cross mod subdivisions. But if you do have a developer that has got some land and it's outside of the city limits, not that we can't do it inside the city limits, but it's best outside the city limits for right now. So we don't have to worry about educating our city officials about cross mods until we have a development to show them. But cross mods is a very smart solution to affordable housing because it's a factory built, stick built home where it's delivered and put on a slab. And then the contractors come back in and they do the tile, they float out the sheetrock to make it a real home. It's built with real wood, real stud sizes, and a real garage, a real porch. I mean, like, it's not a manufactured home, but it's built by Clayton. So it's called cross mod. It's cross between a manufactured home and a modular. It's really like a modular home delivered. But it's got some really cool financing features whenever you have that subdivision. I had a developer, we were ready to go, and they decided to sell the land instead. So hoping to get that going with a new investor maybe. $62,000 is the income, and it is qualifying income on the 321, that Home Depot program. So if you guys are talking to a customer and you think that you've got a customer that might qualify for that program, just tell us, hey, listen, I got them all excited about your 321, the Home Depot program. See if that's an option. 62. Again, we don't have home equity options like other states. We do have a doctor program coming, and it's 100% financing. We should have that shortly. Temporary buy downs, we talked about it a couple of times, is a good solution for people. Again, you just have to do the math and see what the cost to the seller would be. But you can ask the seller to either buy the rate down for the customer for 3 years, or they buy it down for 2 years. But in most cases, unless someone does not have the option, like they have only their down payment money and they need the seller to help them with the rest of the cost, that may be, a buy down might not be an option, because the only way for them to get into the house is for the seller to cover those costs. But if that's not the case, a buy down, if you've got a seller, I had a realtor reach out to me yesterday, and he's got 2 houses that are ready to do price reductions, and he wanted me to work up some buy down options for him instead, because he'd prefer to offer lower rates to the next buyer with a buy down than a reduction, because they'll save a lot more money on a buy down than they would by reducing by 10,000 or 20,000. So just know that that is really still another good solution. More than anything, I guess I want you guys just to know that there are options. You don't have to be an expert at all of them. You do need to know enough to talk about them. But more importantly, you need to ask questions of people. What's keeping you from buying a house? You said you needed to buy a house. What's keeping you from buying a house? And just listen. And then reach out and see what solutions are available.